Yeah, there's so much to talk about. We've got Trump's 100 days. We have what the Fed is going to do. We have earnings reports. So a lot to cover. So let's get right to it. And let's start with what happened on Friday morning with the report.
That's right. We had the non-farm payroll report. So from the Bureau of Labor Statistics, they said that there were 177,000 jobs created in the month of April. That was better than expectations. When we were peeling it back as far as the details, because the devil is always in the details, it looked like a big driver of that, healthcare, of course, because that's been growing as with the aging population, nothing surprising there. But transportation and warehousing showed a big gain of jobs. A lot of that could be due to people front-loading purchases and getting in front of tariffs. And, of course, if you're buying those and it's coming into the U.S., it has to be distributed, and that's through that transportation warehousing. So it'll be interesting to see the extent to which that gets reversed in the May data, which doesn't come out until June.
Right, exactly. And the other thing that I was looking for, which I did not see, was the Doge cuts, right?
Yep.
And if you look, it really did not show up at all. And I was, particularly looking for the federal employee numbers, which didn't really move at all.
Yeah, and that's really interesting. The Bureau of Labor Statistics, they provide some additional detail about that if you are a federal employee or any employee receiving severance, you are still technically counted as employed. So we're probably not going to see the Doge effect until those severance packages actually cease, which in some cases could be as early as July and others in September.
Yeah, in fact, I even read that there was some that will go to the end of the year as well.
Oh, wow.
So we'll look for those numbers to come through. So we did see that. We saw February and March numbers did come down, but the unemployment rate really didn't move. And the other thing was wages were up by, ready for this, 6 cents an hour across the entire report. So really kind of flat. So that suggests, Brian, in my idea, that wage inflation has really been removed.
Yes.
And that puts pressure on the Fed, in my opinion.
You're right. The Fed has been saying for the last few meetings in a row that wages are not contributing to inflation. So I think that they have been trying to get people almost dislodged from this idea that you'll get this wage price spiral. And that's just the idea that if you have inflation, wages go up, higher wages lead to higher inflation, and it's this bad feedback loop that you get into. And they've said that doesn't seem to be in the data. They're not too worried about that. And in this case here, now that we're seeing wages, I think year over year is up like 3.8%. And if you have inflation that's around 2.4 to 2.5%, at least real wages are still positive. They're still growing.
And growing faster than core prices.
That's right. And that's a key thing for standards of living.
Yeah, for sure. So this, to me, is going to put pressure on the Federal Reserve. Now, they're getting enough pressure from 1600 Pennsylvania Avenue. Obviously, Chair Powell really has kind of dug his heels in, which I don't love. And it's just because the fact that he's getting pushed, he says he's not going to lower interest rates. But he's got to pay attention to what the bond market is telling him, and that also has come back down.
That's right. The 2-year Treasury yield is one of those indicators that we tend to look at as far as what is the market expecting for the Federal Reserve to do over the next 2 years. Because when you have these short-term interest rates, you can think of them as being like an average of what you expect the overnight rate, the federal funds rate, to be over that horizon. The 2-year yield being lower than the federal funds rate is an indicator, not necessarily that the market is saying you have to cut, but thinking that the Fed will cut rates. And when I listen to the whole committee, because the chair obviously plays a very important role, sets the agenda, but it is a committee decision. It does sound like the majority of the committee members are going to support rate cuts. Not necessarily big cuts coming soon, but let's say come June, they could cut by another 25 basis points. They've been on pause, but I think they could hit the play button once again.
So let's change topics. And, Danny set up the entire segment by saying, by referencing the McDonald's. And one of the good things is I know you are very thin and in shape, and you don't wait for McRib Day like I do. But Danny set it up as a mix. What is it?
The McRecession.
As a McRecession.
Yep, that's right. So this was a term that I heard from a few people to refer to sales at McDonald's actually declining. What they are saying is that lower income and even the lower end of middle income consumers are beginning to cut back even on those McRibs and the Shamrock Shakes and all those other delicious
Ooh, I'm
things.
getting hungry.
That's right. And so it's not just McDonald's that is saying that it's the lower income to middle income consumer that is beginning to cut back. Wendy's has said that as well. In Yum Brands, so they own like the KFC, Pizza Hut, and Taco Bell. Taco Bell was showing an increase in sales, but Pizza Hut sales were down. So it seems like at least in that fast casual or quick service restaurant category that they are really concerned about the health of not necessarily all consumers, but it's more that lower end of middle income and lower consumers as far as the pressures they're under.
And we're going to have to continue to watch that. And the last thing I do want to get to is the other 493. Right.
Yes.
So we talked about the Mag 7 for a long time, and they have been getting beat up pretty good. But the other 493, which we have been talking about for a couple of years now, have done okay.
That's right. Over the last 2 years, the Magnificent Seven, so the big seven tech companies that were driving the market higher, how concentrated the market was. It's like if you strip out those companies, if you weren't invested in them, you were really kind of flatlining or really having meager gains with your portfolios. It's really flipped. It's become instead of the Magnificent Seven, more like a mangled mess in terms of you have companies like Microsoft and Meta. They knocked it out of the park with their earnings. Stock prices reacted favorably. But then you had Apple and Amazon, which seemed to be more on the front line of the tariff fight, that their earnings were a little disappointing and they really underperformed. So it's really the other 493. And in fact, the other almost like 4,000 companies that are traded in the United States, they've been doing quite a bit better than if you were just concentrated in those few seven companies.